Tuesday, November 8th, 2022. Maneco 64, home of alternative economics and contrarian views. Today we're going to look at bonds, how they function, the mechanism of bonds, government bonds, mortgages, and yes, many of you asked me many times how do bond prices and yields work. It's a bit confusing, but it's very simple actually. And the other thing I want to prove to you is that government bonds are like a perpetual mortgage on the nation, and it's an unnecessary evil, but it's all part of this globalist agenda, fiat currency agenda to enrich the top, the people at the top, the 1%, the people who have control of the currency and credit. And that's why they hate gold, because gold is the anti-debt. So we're going to look into that today. Before we go into it, just quickly go over what's going on in the US today. I'm in the UK. I don't follow very closely US politics, even though I hear what's going on. To be honest, I don't follow politics anywhere that closely. But from what I hear is the red wave is going to take over, i.e. the Republicans are going to get a majority in the House and in the Senate. Of course, the Democrats will still be in charge until the beginning of next year. So it'll be like a lame duck administration or Congress. But my take on what's going on in the US, and I'm not trying to be a cynic, it's just what I see, is more and more division. And unfortunately, it's not only in the US that we're seeing that, it's in the whole of Western Europe and the West, to be honest. And it's all part of this agenda, the debt agenda. And how is that related? Well, we're going to look into that right now. So a lot of you know that I worked in the bond markets. That's what I was trained in, the core of the business of the firm that I first joined back in the late 80s in Switzerland, were government bonds or bonds. Yes, we did other things like stocks and commodities, foreign exchange, but my bosses were really bond people, and they sent me to like a bond course in London in 1990. It was called the Euro Market Trading Consultants, and it was a bond market workshop from February 1990, as you can see. So, and as you can see here on the screen, bond yields are very important. So they've got a little grid here. Basis point yield values of 1 point or 1% move in the price of par bonds. So you can see how time and the coupon of the bond affects prices. And yes, it seems complicated, but once you get used to it, it's easy to understand. So let's start with a definition of a bond. And I think the best way to do that is to look at a mortgage, because a lot of people have mortgages. So a mortgage is a bond. And just think of yourself, if you get a mortgage to buy a house, you're issuing a bond yourself. And who's lending to you? Well, the mortgage lender, investors, nowadays investors through mortgage-backed securities. So let's say you issue a mortgage, and it's done, of course, through the lender to investors. But let's make it simple. You issue a mortgage for 30 years, and let's say it doesn't really matter how much you borrow, but let's say it's issued at par, which means 100, and you're paying 6% every year on the principal, and you pay off the principal as well, of course. So the investor who buys your mortgage at par, he's getting a coupon of 6% and he's getting a yield of 6%. But let's say, for example, 6 months forward, that the mortgage that you sold in the secondary market is trading at 105. So the price has gone up. And why is the price gone up? Well, because the economy is doing well, inflation's under control, unemployment is low. So lenders are willing to get less than 6% because the economic and financial environment are quite benign. So if the price goes up to 105, let's say, and I'm not going to work this out exactly, but the yield, let's say an investor buys that mortgage for 105, he's going to still get the 6% coupon, but it's going to be on $105. So the yield is going to be less than 6%. So that's how that works. And when the opposite happens, and when prices go down, and why would prices go down? Well, inflation goes up, the economy is not doing well, unemployment is going higher. You know, there's a lot of people, how can I say, defaulting on mortgages, and investors want more return because there's more risk. So the price drops to 95. They're still getting the 6, but they're only paying 95. So the yield is going to be higher. So that's how that works. And the same thing for governments. That's what government bonds are. They're just like a government mortgaging you. And that's the main point of this fiat currency system, and why the national debt keeps going up. They're mortgaging you and future generations, the nation, because, yeah, if you notice, ever since this Federal Reserve was created, the national debt has gone through the roof. I think it was around, I don't know, 2 billion at the time. We're now at almost 32 trillion. So, and it's the same thing. If the economy is doing well, we've got a Goldilocks scenario. Deficits, budget deficits are pretty low. Inflation's under control. The political situation is okay. Yes, the government is not going to have to pay so much to borrow. So it's easy. But what we've had this year, when the year started, the 10-year yield on the 10-year Treasury market in the secondary market was around 1.5%. So if the US government had to borrow in the primary market, and that's when they issue the debt, right, initially, they would probably have to pay just a 1.5 coupon, and they issue it at par. But this year, with inflation getting out of control and not going down, with all the troubles, geopolitical, people want more, investors want more for their money. They want more return because it's riskier. You've got inflation running at double digits, really, not really 8%. So the yield on the 10-year has gone up to like over 4%. And how did that happen? Well, because investors are selling these treasuries because they're they're not good enough. They want a higher yield. So that's what happens. And also the Federal Reserve is raising the short-term rates, which affect longer-term rates. And government bond yields and the secondary government bond market is the benchmark for all of the debt, corporate bonds included, mortgages included. So, and that's why it's such a problem for the government. That's why their interest payments are going up. Just like for you, for example, here in the UK, a lot of people fix their mortgages for 2 or 5 years, and if they fixed it in 2021, like at 2 or 3%, next year they're gonna have to renew it 2 years later, for example, and it's gonna be more like 6%. So the yield on those mortgages have gone up in the secondary market. So when you go to renew or roll that mortgage again for another 2 years, you're going to be paying a lot more. And so is the government right now, and or corporations. And what that does, that crowds out the private sector, it crowds out the economy, it crowds out productivity, because you're producing and producing, but a lot of your returns are going to pay off debt, and you can't put money or capital aside to invest and grow your business. And that's the whole problem with this fiat currency, central banking, government debt system. And with that, I'm going to recommend to you a really good video about how the system works. It's called Money Mechanics, the Foundation of Globalism. And I recommend the YouTube channel as well. They're out of Sweden. It's called the Free People's Movement. And they talk about the deep state and how they think things work. I agree with a lot of what they say, but I highly recommend this video about the system. And basically they're saying what I've been telling you is that under a fiat currency system, you have to keep the debt growing, because when you issue debt or money with interest, there's never enough money in the system to pay off that debt. So what do? You keep issuing. And that's why this government debt, central banking, fiat currency system is like a ball and chain around our ankles. And a lot of people, the Keynesians especially, and the mainstream economic class, they think that we're richer for having government debt, that the economy needs government debt. But I think it's just rubbish. And that's why we are in the problem that we are now. Economies are slowing down. We've got higher cost of living. Everything is disrupted. It's all the debt. We focus too much on the debt and not production. And in terms of books, I'm going to recommend a couple of books to you. One of the books is very technical, but if you really want to learn about bonds, or what's called also fixed income securities, I'm going to recommend you this here. It's the supposed Bible of the bond markets, and I bought that around the time that I went on that course in 1990. It's called the Handbook of Fixed Income Securities by Frank Fabozzi and Dessa Fabozzi. This is an old edition. You'll probably find a new one. It's the Handbook of Fixed Income Securities. You will learn everything about that you have to learn about bonds in here. And the other one is one that I have recommended many times as well. And you will learn all about the mechanism of central banking, the national debt, taxation, and how it's a perpetual death gauge or even mortgage around people's neck, around the nation's neck. And you can understand why they keep running deficits, budget deficits, government deficits. It's because they have to keep the debt growing, because if they don't, the whole system implodes. So the book is this one here by William Cobbett, and it's a series of letters by William Cobbett back in 1810. He was a friend of Thomas Paine, the man who wrote Common Sense, Paper Against Gold, containing the history and mystery of the Bank of England, the funds, the debt, the lowering and the raising of the value of paper money. So there you go. And it's interesting that this national debt scam, and I call it a scam because it is, all started because central banks were there as a monopoly with the government. And to finance each other, and also to push, divide people as well, foment wars, crises, revolutions, civil wars. And why do they do that? Well, because it gets people behind the government, the state, and the central bank. And it says, yes, we need to borrow all that money to solve things. We have to do it. We have to do QE, and I get pretty upset when people, even the alternative, say, oh, but we did need the QE in 2008. Well, in 2020, the excuse was lockdowns, pandemic, and this country borrowed like 400 billion in a year, and the Bank of England obliged at the time. Now they can't. So it's a whole scam, and I highly recommend that video as well, the money mechanics. It will help you understand, and hopefully this has helped you understand how bonds and yields work. If you have more questions, just ask in the comment section. I'll try to answer it, or maybe next for the next live stream. So looks like Billy's getting up. We'll quickly look at the markets now. It's 8:30 a.m. London time. We've got spot gold at 1668. It's down about 7. High's been 77, and we're right near the lows. Yes, Friday was a great day for gold and silver. Right now, they haven't really been bashed back down, but they're kind of pausing. I think we'll have to see what they do in the next few days. Silver's down 16 cents at 2062. High's been 88, low 47. Dow futures is down 60 points. NASDAQ 100 futures down 1/3%. S&P is down 1/3 as well. Quickly to the currencies. Sterling is down 1/3 at 114.70. The euro is down 1/4 at 99.93. Dollar is unchanged versus the yen, 146.72. Dollar is up slightly versus the Swiss franc, just above 99. And the dollar is up 0.2% at 727 versus the yuan, Chinese yuan. And the dollar is down 2/3 versus the ruble, right around 61. To the other currencies here quickly, through the Aussie dollar, up down 1/3, 64.60. Dollar up 1/10 versus the Canadian, 135.06. Kiwi dollar down 1/3 at 59.16. General commodities, WTI crude down 1/4 at 90.82. Brent is down slightly at 97.30. High grade copper is up 0.15 at 360. And US nat gas is actually down 5% this morning at 668. The Dutch nat gas futures, the TTF, is up 4.5%, around 115. And to finish off, let's look at the bond market. We're going to look at the yields in the secondary market, because that's what we look at, the secondary market. So right now, the UK 10-year yield is up 7 basis points. So it means that the 10-year gilt price is dropping. So we're at 371 right now. And the 30-year is almost back up to 4%. We're at 394, up 8.5 basis points. To the U.S. Treasury market, we've got the 10-year yield up 2 basis points at 424. And we've got the 2-year unchanged at 472. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And with that, I wish you all a great day. Take care. Bye.